Good morning and welcome to the Pureprofile third quarter FY24 financial update. My name's George Kopsiaftis and I'll be your host for today. With us today we have Martin Filz, CEO, and Melinda Shepherd, the CFO. The format for today will be Martin and Melinda will present the presentation that was lodged with the ASX earlier today. It'll probably take 15 to 20 minutes and then we'll open up to Q&A. Anyone that would like to ask a question, please click on the Q&A tab in the ribbon below and I'll endeavour to ask all questions to Martin and Melinda. At this stage, why don't we pass it over to Martin and Melinda? Thank you.
Great. Thank you very much, George. Good morning, everybody. Thank you very much for joining our Q3 update for Pureprofile. We're running through, as George said, the update, and to start off with is a business overview. One of the topics that I've seen there's lots of commentary on is the announcement that we made on Friday of up-and-coming board changes. So just to add a bit of clarification and colour around this, Albert, that's mentioned here, has actually been with the company for 3 years. Albert's deep experience and knowledge regarding existing and emerging technologies, as well as the business environment from a UK perspective, has been invaluable. After 3 years, Albert absolutely feels it's time to focus on his other business ventures, and I'm sure he'll be very relieved from doing late night calls and early morning calls. The other announcement that we made is Linda Jenkinson will be stepping down when a replacement is found as chair. So Linda joined the board in March 2023, as she had an excellent reputation for growth companies, particularly in the US, and is chair of other Australian businesses. It has been decided that due to a difference of alignment between Linda and the board, that Linda has taken the decision to retire from the board. So the two retirements are absolutely unrelated. However, it was felt that a single announcement would be better and cleaner to do. And in actual fact, the announcement why it was made on Friday and not when replacements were found was that Pureprofile was led to believe that news of this was already in the market. So due to continuous disclosure, it was felt that we should make the announcement. So we have a nominations committee set up. So the process started several weeks ago. Liz Smith, Mark Healy and Albert Hitchcock are the nominations committee. They're interviewing really strong candidates for both roles, and we look forward to making an announcement in due course regarding the replacements. And at this stage, that's all I'm able to say regarding the board announcement and board changes. All right, moving on. So as the two announcements weren't related to each other, they're not also related to the strengths of the business. As you can see, as when we set the strategy 4 years ago, which was to focus on data and insights, to grow internationally from that amazing Australian base that we have, and to also expand our rich technology, we have seen continual revenue growth. And here in this table, you can see absolutely quarter on quarter growth that we've seen across the business. And then even in Q4, we've put in an estimate based on the midpoint of guidance. Now, the share price hasn't always aligned with the business strength. And whilst we have excellent funds who support Pureprofile, we're continually engaging with the markets. We work closely with the IR department to do fantastic work to do that. And we're really hopeful that the share market, share price, and with the endeavours and work that we're doing, will actually realign to where we are as a business today. And where we are as a business today, look, I just called out a few achievements that we've done since 2020. So our revenue CAGR is 27% over the 4 years to financial 24, again, mid-range of guidance. Focus, we've increased the rest of the world revenue by 29%, 29% of the total revenue to 43% of the total revenue year to date. So absolute focus, growing that international business. Our EBITDA CAGR has grown 57% over 4 years to again, the mid-range guidance, excluding the significant items. We achieved profitability in H1 financial year 24 from a net loss of $9.8 million in financial year 20. We've grown our client base from 550 to over 800 as of March year to date. Our offices have grown from 5 to 13 countries. We've grown our platform revenue from 0.5 million in financial year 20 to 6.5 million March year to date. We've grown our annuity revenue from 3.5 million to $10 million on a rolling 12 months basis. And also we've enhanced our technology platform. You couldn't have grown platform as we have, grown clients as we have without doing that. And that means that we've removed the technical debt that we had of underinvestment of the company prior to 2020, modernized our infrastructure, and obviously improved performance both internally and for clients. In addition to that, new technology development, SaaS solutions, driving part of the platform growth, client connectivity, directly clients coming to access our systems, improving EBITDA margins, internal efficiencies, and then most recently in the last 12 months or so, AI solutions. So there's just a few highlights that I've pulled out in the last 4 years that we've done as a business in this new strategy. Why do we do it? Like, what's the prize? What excites us? What reason do we 230 people get out of bed every morning? Well, firstly, our global peers, and there are only a few of them who are truly global data and insights companies doing what we do as Pureprofile. Their revenue ranges are Australian dollars 150 million to Australian dollars 1 billion. And the reason they're so much larger than we are is because they've grown, particularly in the US and the UK. They have strong US and UK businesses. And again, I've said numerous times, the UK business up to 11 times bigger than the Australian business, and the US business market up to 40 times bigger than the Australian business. And it's that we're moving ourselves into. In addition, those companies have a number of direct to client solutions that we as Pureprofile don't or haven't had historically and have started to roll out over the course of the new strategy. So where are we at with that? Well, firstly, we've built a really strong platform of people, clients, brand and panel across 4 years, trebling the size of the UK business. And we expect further financial year 25 expansion. In the US, we've also trebled the size of the business over 4 years. We still are remote because it's very expensive launching in the US, and we're ensuring that we are really strategic about investments that we make there. Whereas in the UK, we have a really strong base. We have key clients. We've got 15 plus employees, strong brand, strong data platform that enables us to grow from. And then building out solutions, we've seen platform grow to 20% of revenue. And in addition, we're continually identifying new client solutions that we can roll out as a business in our independent markets, different markets. As a company, we've also got tremendous tailwinds, and I've specifically got this up as tailwinds. Obviously, every organization, I can talk about economic, climate, etc. When we talk about headwinds, but here I'm just talking about tailwinds of the business. So what do we look at that differentiates Pureprofile? Well, firstly, there are data quality issues in our industry today, not within Pureprofile. So that's a big differentiator and why we're winning so much market share from our competitors around the world. Peer group, that peer group I talked about, they have specific business challenges, might have been purchased by private equity firms, might have had changes in their investment, might have problems refinancing debt, etc., etc., etc. We're winning market share from them because, again, there's confidence in what we're doing as Pureprofile as a business. We're able to attract amazing people. And we attract amazing people because they want to join Pureprofile because of the results we're getting, the relationship that we have with clients, and that we put all of our employees first, which again means clients want to work with us. So we really are attracting the most amazing team around the world. And then I've added this one's point 4 because it's a topic for everybody. Look, it's the rise of technology, but here specifically, I'm talking about the rise of AI. So fully embracing that, seeing that it's enabling us to deliver to clients faster, more higher quality, more cost effectively. It's adding efficiencies to our own internal business processes and the way we work. And I've already given examples of how we use AI translations, for example, for everything that we do now versus translation agencies that saves us money, speeds up the process, delivers a high quality. We've got new client solutions, that many of which are at alpha stage at the moment, that we're developing through, and I hope to make announcements as we bring those to market. And what that all means, and actually this is something that AI has brought to all businesses, is actually a faster development, a sense of innovation, a focus on innovation, and an ability to deliver faster to clients. So we've got a really big opportunity, continue to lean into that big opportunity, and some nice tailwinds as a business. And with that, I'm now going to hand over to Mel, who's going to go through some financial data.
Thank you, Martin. If you can go to the first slide, thanks. So we had our strongest Q3 that we've ever had for this financial year, which is pretty consistent with the trends that you've seen year on year for us. Actually, each year we continue to grow. That said, Q3 is seasonally our lowest quarter of the year. And so it typically contributes about 23% of our revenue for the entire year. Q4 is typically the highest, Q2 is the second highest, Q1, and then Q3. So the pleasing news for Q3, and for those of you who joined our half-year update, was we had a really soft Q2. Our Australian business was in a really challenging trading environment, and that resulted in Q2 revenue growth of only 1%. And that was following a much stronger Q1 year-on-year growth. So we're really pleased to communicate that our Q3 has really come back. And really importantly around Q3 is March in particular. It was the second highest month that Pureprofile has ever had for revenue, and that was only, the highest month was only $27,000 higher. So what we're seeing here is, whilst the trading environment in Australia is tough, and I'm sure it's tough for a lot of businesses at the moment, we have had an uplift in that market. Our sales team are working incredibly hard to really get out there and fight for every dollar that we can in our industry. And that really has played back out in what we've seen in March. And I will talk a little bit to our guidance for Q4 and the full year coming up in another slide. So I suppose the headline there is the growth is coming back, which is really pleasing. And we are seeing a strong Q4 through our pipeline at the moment. Obviously, April's finished now, so we have a fair view of what that looks like. And we can see what's sitting in our pipeline at the moment for May and June. The rest of the world is still growing strongly, and that's really helped contribute to the overall revenue growth. So for the quarter, the rest of the world, which includes the UK, it includes the US, it includes Southeast Asia, India, and Europe, was up 11% on the prior quarter. wanted to have a little, just a chat around EBITDA. So EBITDA was $500,000, so it was positive, but it was a decline of 49% for the quarter. So there's a couple of reasons why that was down year on year. And the first thing I kind of want to say, again, this sort of relates to our cost base that we have throughout the year is relatively consistent because, we're going from a really a lower quarter such as Q3 into Q4, which is seasonally very high. So we have, being a managed service, we have the cost base set up for in Q3 for going into Q4. We obviously want to make sure that we can deliver all the projects that we have won during Q4. So we need to make sure that we have that cost base set up. So the reason also for the decline year on year, and noting that our cost base for Q3 was relatively consistent with Q2. So there were no new substantial investments that we made in Q3 that have resulted in this decline in EBITDA. There was a part impact related to the executive remuneration policy. If you will remember, we actually have shifted some of our incentives from equity-based to cash-based. So instead of being considered a share-based payment, it's now considered an operating expense. And then the other explanations to this decline is related to the investments we've made in people. So we have hired more staff members throughout the financial year, including sales and operations teams to help deliver the revenue, and also to make sure that as going into the new financial year FY25, that we can actually continue to grow the business. The second point is we're actually in the process of getting the ISO 27000 accreditation. For those of you that are aware of what that is, it's effectively an international standard around data security and IT security. Increasingly with a lot of the cybersecurity breaches that we are all hearing about, obviously a lot of clients would be requesting that we have this accreditation. But there's another important commercial reason that we're doing this. A lot of government contracts require you to have this ISO accreditation. So we embarked at the start of this financial year on obtaining this certification. It does require investment. There are a number of pieces of software that we've had to put in place. We've also obviously got a company helping us implement this because we are still a relatively small organisation. So we're doing this obviously to help bolster our own information security, which is absolutely critical at the moment. It's obviously a business risk for a lot of organisations. So we want to make sure that we're doing everything we can to mitigate that. And then we also believe that there's a commercial reason for us to do that. We will pick up more government contracts if we have this accreditation. So if you go to the next slide, Martin. Financial metrics, these are all relatively consistent with what you've seen previously. Obviously, you can see the ANZ the ANZ trends are softer going into for the quarter, so only slightly higher than Q3 last year. That's the 1% growth. The 6% growth that we were talking about. The rest of the world, the 11% growth you can see there. Platform revenue is really where we've had the significant growth over the last, and you've seen that extrapolate every quarter. And then the EBITDA decline that I've just talked about with the changes to the remuneration policy, the investment in IT security, and then also investment in headcount to help us continue to organically grow our revenue in Q4 and going into FY25. We've also put in our 3-year CAGRs on each of those particular items on that spreadsheet, on the slide. Just noting that the CAGRs that Martin mentioned in the achievements were actually 4-year CAGRs because it was from FY20 on to 24. Go to the next slide. So how are we tracking from a year-to-date perspective? Well, really, the international revenue growth is actually what's really driving the revenue growth. You can see here that our revenue year on year is now at 7%. Again, we're really have been impacted by what's going on in the Australian market, which has obviously been the largest portion of our revenue over time. Pleasingly, as we've grown to over 40% of our revenue coming from outside of Australia, if we had not made that sort of strategic change over the last couple of years, I suspect this result would have been far worse, because we wouldn't have had that international revenue really helping bolster our revenue growth overall. So in regions outside of Australia, we were 18% up on the prior comparable period. And that's, that's a result of also having a much stronger Q3 than we did for Q2. EBITDA is now sitting at about 2.9 million, which is down 10% on PCP. So the EBITDA decline in Q3 is really what's driven that. You will recall at the half year, EBITDA was still up year on year. And that's representing an 8% EBITDA margin. If we kind of excluded the impact of the cash STI, the EBITDA margin would have been flat on last year at 10%. So that has impacted us. You can see here again, the revenue growth. ANZ was 1% up year to date, rest of the world 18%. And you can see that actually the gap between ANZ and the rest of the world is really narrowing. So 20 million versus 15 million. And then our platform revenue growth is really strong. As the revenue is down, you will see that the platform is comparatively to Q2, Q3 was still not at the same sort of quantum, even though the growth year on year was really strong. Go to the next slide, please. So these are the things that we're focused on for Q4. Obviously, heavily focused on what we can do within our Australian business. So we really are focused on growing our Australian business from both a revenue and a profitability, and also focused on going into FY25 and beyond. Continuing with our UK expansion and supporting our new Spanish and German businesses. So you might recall in January, we had 2 new team members joining us in those regions. So we've been really helping them to establish themselves in those markets and ensuring that we've got the right infrastructure around them to be successful. Another key priority for us, as always, is data and panelist growth. So we're starting to work more with AI and technology providers, and really trying to focus on what we can do in that area. Technology improvements, again, a huge focus for us. So continuing to develop those AI solutions and implementing them, the ones that we have developed in H1, to continue to create those efficiencies and enhancing our client solutions. So we're starting to realize some of the benefits from some of those AI solutions within our operations team, and it's giving us a lot more visibility around the team there. So that's been fantastic. And a really big one, NPAT profitability. We were so pleased to be able to announce in H1 that we were profitable, and we are going to continue to focus on maintaining that profitability and obviously growing the profits for the organisation. But we also want to make sure that we're continuing to make measured investments in the organisation so that we can continue to grow the top line. And obviously setting ourselves up for FY25 and beyond is absolutely critical going into Q4. So making sure that we've got the right teams, the right investment in place to continue to grow revenue and profitability over the next financial year. So that's really where our headspace is at this point in time. Next slide, please. So just a bit of an update on revenue guidance. So what we've done here, look, we've obviously already just embarked, we're partway through Q4. So we have a good idea about where we think we'll end up for the financial year. So what we've done is we've taken the opportunity to revise our financial guidance. You may recall that we had a guidance range for revenue from 46 to 51 million. We are now confident that that revenue number will land between 48 and 49 million. Shame it's slightly shy of 50 million. That would have been a wonderful milestone for us to hit. But again, the softer Australian market has really impacted us this year of hitting that sort of higher range that we put out from our AGM. The next point is our EBITDA margin. So previously we've given guidance around EBITDA margin. So we said 7% to 9%. We're confident to put out our guidance being 4.1 million to 4.5 million. Just remembering the difference year on year is that we are now accounting for the cash-based STIs in the operating expenses. So that hasn't had an impact on EBITDA. And then just really the final thing, and I did include this in the other document, is that we've put in where we believe the cash at bank will be resulting at the end of the financial year, and we put a range of 4.5 to 5 million. Typically, Q4 is a strong quarter for cash collections as well. So I mentioned that in March we had the second record revenue month for the year, and we will see those cash receipts from that strong month in the Q4. And Q4 obviously being strong, that some of those cash receipts from the revenue that we will recognise over that quarter will fall into this financial year. So that's where we are from a revenue guidance. So we've strengthened, finalised and put those numbers in so that you can see that whilst we had a softer quarter for Q3, the growth's come back, the EBITDA result is softer for Q3, but we are very confident about our guidance range that we've now given to the market. And I think I'm handing back to Martin to just wrap up now. You're on mute, Martin.
Gosh, we've only been Zooming and whatnot for years, so I should be used to that. Thank you very much, Mel. So the summary is, look, it's record continued business third quarter revenue achieved in Q3 24, despite challenging trading conditions in Australia. A recovery in trading conditions for Australia in March, which plus 16% on previous year. International business continues to grow much faster than the ANZ growth rate, and that's where we've been putting all of our investment. Board refresh is underway, strengthening the board with hopefully some also industry experience, and finish the year strongly. Achieve our guidance that Mel's just been through, which is a great result for the business. Implement our actions to really add shareholder value and get that share price back to where it should be. So thank you all very much, and handing back to George.
Great, thank you for that summary, Martin and Mel. Just as a reminder, if you'd like to ask a question, please click on the Q&A tab in the ribbon below, and I'll endeavour to ask all questions on your behalf. First question, can we please get an update on client growth in the individual countries in India, Singapore, the UK and the US?
Yeah, thanks for the question. We actually don't publicly produce individual client counts per country, but we'll take that on board as some shareholder feedback, and we've got the obviously full year results next, and so let's look at seeing if we can have that or some version of that in full year. Thank you.
Right, thanks, Martin. Next question, when will the company truly be NPAT positive, and what's the outlook over the next 6 to 12 months?
Yeah, so I suppose the guideline of that, of the next 6 to 12 months, I mean, obviously the next quarter, we've put out our guidance for the full financial year. Obviously, NPAT profitability or being profitable is our key focus as an organisation. I mean, that alongside with being cash flow positive over the long term. So we would expect that there's no change to our profitability. There's no change in our strategic direction that would signal that the business is going to sort of shift from being profitable to being unprofitable again. So at this point, what you've just seen in half one of the financial year, I would expect that you would see that continue on in the rest of this financial year, and then moving into FY25 as well.
So again, that key point we said we were NPAT positive for the first half of the year, just to reiterate the previous releases and what we talked about earlier, and what Mel's covered is, are we going to be for the full year?
Great, thanks, Mel and Martin. Just as a follow-on question, what could go wrong to change your guidance for FY24?
So we, as I said in my little section, we have a good view of what's in the pipeline for May and June. I think if you kind of think about the risks around revenue, what a potential risk is that some of those projects are shifted into the new financial year because clients maybe want to save their budgets for this financial year. But bear in mind, because we are a global business, not every country that we operate in has a financial year of 30 June. So as we've managed to grow our external revenue, our outside of Australia revenue, that means that, the UK clients, for example, they have a 31st of March financial year, and others are all more on the calendar year. That sort of really diversifies that risk of businesses pulling back investment in the last quarter of the financial year. The only other thing that I'd probably add to that is it's maybe more so Australia that, what goes on in the macro environment around interest rates, etc., means that companies may pull back or delay some of their expenditure or actually just reduce their expenditure in Australia. I mean, that's kind of, while the trading market's been difficult in Australia, what we're just seeing is clients are spending less. So they're still doing projects, but not spending as much. Because they still want to do research. Like, it's still a really important part of what they do, is making sure that they've got research to help them with business decisions, etc. So I suppose the key risk would be that in Australia it continues to be softer, but that's definitely not what we're seeing, and it's not what we're hearing from the sales team. Like, it's absolutely a challenge for them out there, but I think they're really absolutely rising to the occasion and making sure that they're not leaving any money on the table when they go in and talk to clients.
Thanks, Mel. And just as a follow-on, while you don't provide FY25 guidance, there's a question here asking, is there any investment needed to reach your FY25 expectations?
Yeah, well, so we would continue to invest in sales capability and obviously operations capability, but at a lower level than what we've previously done. As we've talked about, some of these AI initiatives and other technology initiatives we've been implementing have helped us reduce the same quantum of operations resources that we've maybe hired in the past. So we won't need to hire as many team members in either our India or Philippines hub to sort of support that revenue. We will still need to hire some roles there. So we will continue to from that perspective. And then obviously, along with other investments that we would have made, like continuing the investment in technology, and then also panel. So continuing to invest from panel, but you would not expect any significant investment over what we've been doing on a run rate basis this financial year. So just the continued organic growth that we've done.
Thanks, Mel. Next question. Please, can we get an update on the partnership deals in the US and elsewhere?
Yeah, so we still haven't cracked a big partnership in the US, which is focused. We've had a few close ones, but hasn't come to fruition yet. We've got our first larger UK partnership. It's with a company called Sprive out of the UK. That went live about 2 weeks ago, and yeah, we've seen audience members come from that. It's only been a soft launch, and we've got revenues coming in. Members have joined, data points, etc. So Sprive is the first one. That's a significant one in the UK. So we'll give updates on that as we receive it. But that's a soft launch stage. And then we've also got a nice partnership that we'll announce soon, which is also due to go live perhaps today in New Zealand, which is again a really nice one that will help us grow revenues and reduce costs. So looking forward to those two. Don't have any updates for any US ones at the moment.
Great, thanks. Next question. What productivity measures can you share that demonstrate ongoing improvement?
Yeah, so one obvious one just talked about is the fact that we do all of our translations via AI translations now. That added about 300,000 to our bottom line by not going out to agencies. So that's an advantage. Another productivity one of the measures that we've taken, because the Australian market is soft, is obviously there's pricing pressures. But in the organisation, you're not seeing any reduction in our gross margin percentage, and in actual fact, seeing an expansion, as Mel said, underlying the EBITDA margin, underlying the year to date. So what we're able to do now, we've added some very clever AI tests at the beginning all of our surveys. And actually, that's reducing the cost a great deal on third-party sample that we spend. It's increasing our own yield of our own data and our own sources. And overall, that's reducing costs. So that's a big advantage. The other one is, which you won't necessarily see, but will play out over time, is, as Mel pointed out, as an organisation, it's for us about growing on this amazing people and amazing base that we have. So where we've rolled out efficiency tools within our operations team, the goal there is actually, as we grow revenue, and as we move Q4, financial year 25, etc., is that we don't need to add as many operations team members. And Mel said that just a moment ago. And so you will see those efficiency gains and those operational efficiency come into the business. And then also when we look at our technology, our technology team is slightly smaller than it was 12 months ago. Doesn't need to be the same size it was, because again, it's easier to develop systems, develop code, write code, etc. So we're able to be more efficient, but equally faster. So seen a bit in technology, you will see it in operations. You've seen it in cost of third-party sample and efficiency of our own, and also in real costs of us going out and doing business.
Thanks, Martin. Next question is probably for Mel. Why are share-based payments still being made?
Yeah, great question. The chair that was appointed, Linda, in May last year, was given some options that vest over a 3-year period. So the way that you account for share-based payments is they are accounted from the date they're granted, and obviously there's a value attached to them. Well, there's a value that's actually at the time that they're granted. You don't readjust the valuation of share-based or the value of the securities that are given out over the life of the vesting period. So there are expenses related to that. And then there are some small share-based payments related to the prior period LTIs that were in place, because they vest over multiple years. But predominantly it's due to the chair options.
Okay, thank you, Mel. Next question. Does the revenue growth in May and June reflect similar run rates to March, i.e. continuing to see improvement in Australia?
Yeah, I mean, if you sort of get your calculator out and you work backwards with the full year guidance at the midpoint, you can see that, yeah, that would suggest that the March sort of result would continue going into April, May and June. That said, we are expecting for outside of Australia a really strong quarter as well. We've got some of our clients there that have got quite a lot of activity in our pipeline, some larger clients. So I think it's a combination of both markets, but definitely we're feeling a lot more positive about Australia at this point in time, but that can obviously change if something in the environment changes more in Australia.
Great, thanks, Mel. This next question, they refer to EBITDA. I think they're actually they mean revenue, but I'll ask the question. It says, Martin, do you expect to continue growing EBITDA 15 to 20% organically to reach over 80 million per annum in 3 years? Now, I guess given your revenue is somewhere around the 50, or guidance is for around 50, they're probably referring to revenue rather than EBITDA.
Yes, I would think that's a revenue question. Look, we're just in the process now of rolling out, discussing, agreeing our 3-year plan moving forward. So I expect that to sort of be first quarter 25 to be in a position to have that. And perhaps we would talk to some of those points at the AGM presentation. But if you look at the history of the business, you look at the organic growth of the business, then one would say that. And we've had a slowdown in the Australian market, their economic cycles. It's not an issue within the industry, it's an issue within the economy. So if you look at that, you would say yes, looking at the history. I think in addition, the other point to mention is we're now in a position that we have a strong balance sheet. You know, we've got the opportunity today to perhaps start making acquisitions, to be able to, out of cash, to be able to look at bolt-ons that give us a lift to our strategy and a step change to what we're doing as a business. And again, that's the work that's been done over the last few years, cash flow positivity, EBITDA growth, etc., that has enabled us to be able to start looking at that. So I think if you combine the fact that we're growing strongly in the rest of the world into low market share, we haven't even scraped the opportunities in UK, let alone properly in the US. If you add to that we can start to make perhaps some bolt-on acquisitions, I think you can extrapolate those numbers.
Great, thanks, Martin. There was actually a question similar to what you just spoke about. The one bit you haven't referred to was dividends. I mean, is there any talk of dividends in the future?
Look, one day in the future, that would be nice. I think all the shareholders would appreciate that, and clearly we see a correlation to that in the share price. I think today, for us to use capital, we're better off where we are making investments into, as Mel just talked about, commercial teams, growing out commercial teams, especially in the UK, growing out our data points, and perhaps make some bolt-on acquisitions. That should be a better return on investment for our shareholders than actually paying dividends. So let us get established, let us have NPAT positivity, a couple of years under our belt, and let us do what we want to do with the investments.
Right, thanks. There was a question that came in earlier in the day over email, and it was, are you happy with all your KPIs set out approximately 24 months ago?
Yeah, that's a good question. It depends which KPI. Yeah, sorry, the answer is yes, and then it depends which KPI. So STI, short-term incentive KPIs, set every 12 months. 50% financial gains, revenue and EBITDA, and 50% are business targets for executives and management team. I think, again, going back to one of the earlier slides, you've seen the results, revenue, EBITDA, etc. You've seen the guidance for this year, and you've seen our achievements in panel, etc. They're the sort of things that sit within the STI. So the board feels, and we've delivered to date everything that's been asked of us and everything that we've said. If you look at the LTI STIs, which I think we're talking about, were set 2 years ago, and that was about shareholder return. So us being benchmarked for growth against a peer group of companies. And there's work to be done. You know, we had a hit last Friday with the announcement that came out about the board changes. I think we need that to settle down, see our full year guidance come out, good result, maybe some other announcements at the end, beginning of next year, and then we've got next year to see our share price come back. So there's work to do still on the share price. I don't think anybody disagrees with that. That's the LTI KPIs, STI KPIs we're delivering on a business front.
Right, thank you. I'm not sure if you spoke about Asia earlier, but there's a question here. You haven't mentioned Asia. Is there a problem, and is the margin still growing?
Oh yeah, look, no problem at all in Asia. I think we added to our Indonesian office this financial year that we've talked about. We've just launched a Indonesian panel as well. That's growing well and doing very well, and under amazing leadership of a gentleman called Keith Ang, who reports into Anna, based out of Sydney. And the Asian business is doing very well. There's only so much we can talk about in an update as this, and we were focusing on what we've done in the UK and US. But yeah, really happy with how that team's building out, and the return on investment that Keith and the team are making on every dollar that we give them.
Yeah, the only thing I'd add to that too is, if for those of you who follow us on LinkedIn, you'll see that we actually participated in the first sort of industry conference in Southeast Asia and Thailand only a couple of months ago. So we had our team, our Indonesian team members, and our Singapore team members attended that conference. Keith actually presented at it, and we generated a bit of business out of it as well. So we are active in that region. It's obviously a small region for us, so we don't spend a lot of time talking about it, but it's still a very important part of our business with good margins and returns.
Great, thank you. Well, I'm just cognizant of the time. It's just past 11:45. Martin, would you like to make any closing remarks?
The closing remarks are, look, thank you for the feedback. Thank you for the input. Sometimes it's painful when you read some of the comments on Hot Copper. And please, if you ever want clarification on us as a business, feel free to reach out to George at the IR department, myself or Melinda. And please feel free to do that. But we've got great business, and the strategy is working. The same strategy that we've had in place. We continue to execute that, continue to get results on that, and the business KPIs of the business and key measures of the business continue to grow and go upwards. And for that, I thank all of the teams that we work with, all of our management team, the executives, and obviously our other stakeholders, clients, and panelists. So thank you to everybody, and keep tuned. But yes, feel free to reach out if you need clarification on anything.
Right. On that note, I'd like to thank Martin and Mel for presenting today. And thank you to everyone who participated. We look forward to keeping you updated as and when we have new news to tell you. So thank you, everyone, and see you shortly.